All right, welcome to week 4 of mergers, acquisitions, and private equity. We are now getting into the actual legal aspects of mergers, acquisitions, and private equity. So, last week we said that we'll be focusing more on how companies raise money through the PE or the VC route. I think it's a good thing to first talk about what is a PE or what is a VC or what is an investment bank. All funds work in pretty much the same way. A large number of people put in their resources, pool in their money into one pot, and then they assign that money to a manager. Now this person is known as a fund manager. Now this could be applicable in case of a mutual fund, a hedge fund, a venture capital fund, a private equity fund. All of them pretty much work the same way. Now with this pool of resources, the manager decides where that money is going to be invested. This could be thematic, as in the money could be invested only in infrastructure companies or only in real estate companies or only in the oil and gas sector or only in tech, right? It could be invested in, let's say, debt instruments, for example, fixed deposits, or could be given out as loans. So the fund manager decides where that money is going to be used and how it's going to be used, right? So don't be confused by differences in when we're referring to a VC, we're referring to a venture capital investor or a venture capital fund. When we're referring to a PE, we're referring to a private equity fund, right? But both of them work in pretty much the same way. The only difference that we see in terms of the private equity industry or the venture capital industry is that funds that typically invest in smaller startup companies, these are known as venture capital investors. Venture capital investors will pretty much work with, let's say, biotech or technology or pharmaceutical companies that bring on a new innovative kind of technology, right? And typically VCs will fail more often of the time. Private equity investors pretty much do the same thing, but to more matured companies that have seen a couple of rounds of investments already, right? And we'll talk about rounds of investments, first, second, third. We can call them series A, B, C, etc. We'll come to that in a bit, right? But first, let's figure out how can a company raise money. Now, individuals and companies can raise money in pretty much the same way, right? There are 3 ways. The first is, if you had to raise money, you could probably sell off some of your assets, a book that you don't need, or a pair of shoes that you don't wear anymore, clothes that you've outgrown, right? And this can be done by a business as well, by hiving off or selling off assets that it doesn't need anymore, perhaps non-performing assets, right? So this would be known as an asset sale, right? And we've talked about this in the past, where we can actually hive off certain parts of the business and sell them off piecemeal, right? In terms of plant and machinery, in terms of inventory, and perhaps letting go of a few employees as well. The second way companies raise money, and the second way we can raise money as well, is by taking a loan or raising debt, right? Now, debt can be raised for multiple purposes. It could be for a fixed purpose, right? Like, for example, buying new land or setting up a new plant, buying new machinery, or it could be for general working capital purposes. Now, we've taken a look at how companies raise loans and how companies can secure those loans by way of a company charge. We've talked about charges in the past. We've also studied charges in basic company law. But raising finance or raising capital or raising money through the sale of assets or through taking of loans is not what this course is about. This course specifically talks about raising money by the issuance of shares. When I say shares, we are including shares, convertible debt, and convertible preference shares, right? To understand this, we now need to understand what preference shares are and what convertible debt can be, right? So we know what equity shares are, right? So that's easy. Equity shares are plain vanilla units of ownership of the company, which give you a right to vote at a shareholders meeting as and when it is set up, or it gives you the right to receive dividends as and when dividends are declared. Right? Now, these are the two basic statutory rights that are there in all equity shares. Now, let's talk about preference shares. There is a marked difference between preference and equity shares. And this difference comes from what I refer to as the risk-return duality, right? Now, we know for a fact that the higher the risk, the greater the return, right? But the chance of that return is going to be lesser in probability, right? So, for example, you must have heard this quite often in these ads. Mutual fund investments are subject to market risks. Please read the offer document carefully before investing. When you are investing in an equity-linked instrument or equity shares, there is a chance that the price of those shares, the value of those shares, could go up and could go down, right? So you have that risk, right? However, preference shares do not carry that risk. Preference shares have what is known as a guaranteed rate of return, right? This is known as a coupon rate. Now, coupon rates could vary, wildly. It depends upon how the company is structuring its preference shares, how the company is negotiating with whoever's buying these preference shares, right? In other words, preference shares are like equity shares, except that they have a guaranteed rate of return, right? They do not, of course, there are other differences. Preference shareholders do not get to vote on any of the matters in a general meeting or in a shareholders meeting. However, when it comes to liquidation, preference shareholders have, again, that's why they're called preference shareholders, they have a preference over equity shareholders. So basically, three differences between equity and preference shares. The first is that you do not have a guaranteed rate of return in equity shares, but you do have a guaranteed rate of return in preference shares. This is known as the coupon rate of a preference share. Second, preference shareholders do not get the right to vote on shareholder resolutions. Third, when the time comes for liquidation, preference shareholders are held in preference over equity shareholders, right? Now, this is known, so when we see the risks and the returns between equity shares and preference shares, we know for a fact that preference shares are a safer bet. We know for a fact that equity shares are riskier because there's no guaranteed rate of return. However, in case you've noticed, with greater risk comes greater control, right? So while equity shareholders can vote on shareholder resolutions, preference shareholders can't. And of course, at the end of the day, when you are getting into liquidation, preference shareholders are held in preference over equity shares. So, to sum it all up, preference shareholders don't have much control, but have greater rewards. Will have a guaranteed rate of return. Equity shareholders have greater control, but there is no guaranteed rate of return. Right? Now, in terms of convertible debt, now debt can be redeemed for money, of course. Debt can be returned, a loan can be repaid, or a loan can be converted into equity, right? Now, companies are able to do this because they can exchange the loan for equity shares. Now, we know for a fact that equity shares are a unit of ownership, but much like currency notes, they are also a unit of value, right? And that value might change, but it has some value nonetheless, right? So the conversion of a debt is nothing but exchanging the loan for shares instead of exchanging the loan for money, right? So if I were to redeem a loan, I would simply exchange the title documents to, let's say, I've secured the loan through a mortgage, and I've given the mortgage, I've given the title documents to the lender. Now, when I'm redeeming myself, I'm redeeming the mortgage, I'm taking back those title documents and I'm repaying with money. Instead of repaying with money, if I were to repay with shares, I'm not redeeming the loan as such, I'm simply converting the loan into equity, right? This is known as convertible debt. Now, for both to understand convertible preference shares and understand convertible debt, they pretty much work the same way, right? We know for a fact that when you get a loan as a lender to a company, as a creditor to a company, you don't have much control over the company unless if the company goes into liquidation or insolvency proceedings. However, much like the preference shareholder, you don't get to vote on shareholder resolutions. You don't get to sit in on board meetings unless specifically required to through the loan arrangement, right? So far so good? Great. So a preference shareholder or a debenture holder or a creditor cannot technically get to sit on a board, cannot technically get to vote on shareholder meetings, right? Unless specifically negotiated for. Now, instead of redeeming preference shares or instead of redeeming debt, I can exchange preference shares for equity shares. This exchange of preference shares or debt in exchange for equity shares is known as conversion, right? And therefore, preference shares or debt which can be converted are referred to as convertible securities or convertible preference shares or convertible debt. Now, while the unit of ownership is an equity share, the unit of debt can either be a bond or a debenture. This is where we're looking at what bonds and debentures actually do. A bond or a debenture is nothing but a loan that has been chopped up into small pieces. Just as we've taken an imaginary thing like a company, we've chopped up the ownership of the company into smaller bits and we call them shares. We take a loan, you chop it up into smaller bits, and each part you call a bond or a debenture, right? Now, as we've discussed before, bonds can be redeemable. Bonds can also be convertible, right? In my mind, there is no legal distinction between a bond and a debenture, right? However, there are obviously differences between preference shares and debentures. We'll come to that later. For the purposes of this course, we will be considering bonds and debentures as debentures only, right? So now, in terms of convertibility, right? There are a number of ways to slice and dice convertibility of preference shares or debentures, right? Now, preference shares, let's take preference shares, right? Let's say the conversion of these preference shares is optional at the option or at the choice of the preference shareholder. We'll call these optionally convertible preference shares or OCPS, right? However, if the conversion has to take place, that the conversion is compulsory, then we'll call them compulsorily convertible preference shares or CCPS, right? We could also say that when the conversion happens, and the conversion will happen at the option of the preference shareholder, only part of the preference share will get converted. So now you have an optionally partially convertible preference share or OPCPS, right? I hope I got that correct, right? Optionally partially convertible preference share, OPCPS, right? It's getting a little confusing, isn't it? But at the base of it all, what you need to understand is that all we are doing is that we're exchanging one instrument for another, right? And how we do it is determined by what we call the instrument. Now, the same can apply for debentures as well. For example, you could have a non-convertible debenture, an NCD, right, which is a straight-up loan, right? You could have a convertible debenture at the option of the debenture holder, optionally convertible debenture or OCD, right? You could have a debenture which is convertible, compulsorily convertible, not optionally, but when you convert, it has to be done fully. So a compulsorily fully convertible debenture or a CFCD, right? And you could have these, you could have multiple variations of these, right? So for example, and we will talk about this at some point of time with the Sahara case, where let's say some of the Sahara companies, they issued what was known as OFCDs, or optionally fully convertible debenture, right? Now figure out what kind of a debenture that is while we continue on with this video, right? Okay, so effectively, a company can raise money through either an asset sale or taking on a loan, or what we'll be trying to figure out in our case, the issue of equity shares, or the issue of preference shares that can be converted at a later date, the issue of debt or of taking on a loan which can be converted into equity at a later date. Now, a couple of more things about compulsorily convertible and optionally convertible, right? Now, it is not uncommon to see companies issuing optionally or fully convertible preference shares, or compulsory convertible preference shares, or debt, where the conversion can happen only upon the happening of a particular event or upon the expiry of a certain period of time. So I could negotiate a preference share issue, an issue of preference shares, which are fully convertible at the option of the preference shareholder. So OFPS, right? Optionally fully convertible preference shares. And that the preference shareholder can convert at his own option only after 5 years have expired, or upon the company attaining a particular net worth, right? We could build all of these into the contract itself. This is why the investment agreement or the share subscription agreement becomes really important, because that is the agreement that will capture all of this information, all of the terms and conditions on which these preference shares or convertible debt is issued, right? Okay.